Hello and welcome to our pre-recorded webinar session made available to MFAA members by the MFAA Diamond Industry Partner, Genworth. My name is Rod Edge, Executive Director, Professional Development and Events, and I will be introducing our panel session today, which is a 1-hour webinar, which also includes a pre-recorded video of the Genworth Homegrown customer launch. Before I commence, a very quick sound check. You should be able to hear me loud and clear. You will not be required to have a microphone. You will need to ensure your speakers are not muted, and doing so is the bottom right corner of your screen on the speaker symbol. Our 1-hour session today is a recorded panel session speaking and chatting about the Australian mortgage market in 2012 and beyond. We address specific themes from Homegrown, such as credit demand, channels, affordability, and innovation. The moderator of the panel session is Ellie Comferford, President and CEO, Genworth Australia. Introducing Ellie, Ellie joined Genworth Australia as President and Chief Executive Officer in late 2010. Ellie brings a wealth of experience to her role as CEO across a range of areas, including insurance risk, lending, and mortgage origination activities, client relationship management, structured finance, and capital markets. Before joining Genworth, Ellie worked at First American Financial Corporation, a leading global title and specialty insurance company, where she was Chief Operating Officer, the international division, for 3 years. Previously, Ellie held the role of Managing Director of First America's Australian and New Zealand operations, First Title, for 6 years. Prior to her roles at First American, Ellie worked at Citigroup for close to 14 years, where her roles included Director of Strategy and Business Development, Head of Capital Markets, Origination and Syndication. Our panel members are 4 industry leaders. To introduce Damon Cook, General Manager, Product Delivery, National Australia Bank. Damon joined National Australia Bank in April 2010 as Head of Business Development, Personal Banking. Damon has over 17 years' experience in the finance industry, including over 10 years with GE Capital as Head of Acquisitions and Business Development, Head of Motor and White Labelling, and Business Development Manager. Damon holds a Master's degree in Marketing from the University of Melbourne. Our second panellist is Bill Evans, Chief Economist, Westpac. Bill is a graduate of Sydney University and the London School of Economics. Bill has worked as a research manager for the Reserve Bank of Australia, Treasurer at the Commonwealth Bank of Australia, and prior to joining Westpac was Director and Head of Financial Markets at Schroders Australia Limited for 8 years. Bill joined Westpac in 1991 in the position of Chief Economist and Head of Research. During his time at Westpac, he also spent 2 years in New Zealand as Head of the Institutional Bank with responsibilities for Westpac's corporate and financial markets businesses. Bill is currently Managing Director Economics. He is the bank's economic spokesperson and is responsible for all the bank's economic research. Bill travels frequently advising Westpac customers on the Australian economy and financial markets. He has developed many important contacts in the US, Europe and Asia. Bill was Chairman of Australian Business Economists for 8 years and is now a life member. Our third panellist, should I say, is Vaughn Richtor, CEO, ING Direct. Introducing Vaughn, Vaughn is CEO of ING Direct Australia. As a current member of the ING Direct Australian Board, Vaughn has an existing understanding of the bank's operations and strategic direction. Vaughn previously held the role of CEO of ING Direct Australia from 1995 to 2005, helping to establish the brand, which became the country's 6th largest retail bank in 10 years. Vaughn joined ING in 1991 as Head of Corporate Banking at ING Bank in the UK and assumed the Deputy General Manager position in 1993, starting the Dublin branch. Based in Sydney, Vaughn will continue to oversee ING's retail banking brands in India, China and Thailand, in addition to his CEO position. And our fourth panellist today is James Symond, Executive Director, Aussie. James is an executive director of Aussie and has been with the company since its inception in 1992. For over 20 years, James has successfully held numerous roles throughout Aussie, leading the group's distribution and direction through over 750 team members. He has led the evolution of the sales team from a single home loan provider through a sole channel to a diverse financial services offering through 150 retail stores. James's leadership in executive learning has been at Harvard and Columbia Business Schools, amongst others, and he has been the youngest president of the Mortgage and Finance Association of Australia. A well-known industry leader, James has a passion for continually raising the bar of mortgage broker professionalism in Australia to ultimately benefit the consumer and ensure a long-term sustainable profession. So as you can see, we have 4 fabulous industry leaders as our panellists. Before I hit play on the video, the first person you will hear from is Bridget Saker, Chief Commercial Officer Genworth, to introduce Genworth Homegrown.
What's happening in the housing loan market is that the consumers really are dictating the points of distribution that the banks are going to focus on, and the consumers are certainly warming to the broker opportunity and option.
Innovation with products, innovation with how we talk to our clients, the features and benefits that we offer in loans, the smoothness of the credit process, the way we communicate with customers. With things like social media and web and that, there is a generation of borrowers coming through now who are much more comfortable talking online.
Banks have a huge amount of information now around their customer, and as we move on, we play on the customer now. It's absolutely what is the customer needing, and now we've got to start using that data to actually understand those customer needs.
On behalf of Genworth, welcome to the launch of our new edition of the Homegrown Mortgage Industry Perspectives Report. Genworth's in a really unique position because we do get to see a helicopter view of what's going on in the marketplace. We deal with just over 100 lenders, and we do get to see a lot of insights. And we do look at segments from lenders to brokers to borrowers, government and industry bodies. What our thought leadership reports do is allow us to share with you from a broad perspective what we see. What Homegrown does is presents the findings of a study conducted between May and October this year. The study was based on opinions from some of you here today in the room, a survey of people working for lending institutions and mortgage brokers, as well as 6 in-depth roundtables with key participants from lenders and brokers across Australia. What that's resulted in is a comprehensive report which actually looks at opinions across the industry about the mortgage market in relation to current and future credit demand, channel distribution, home buyer activity and affordability, and product innovation. As you're aware, we do conduct the Streets Ahead report twice a year, and that allows us to measure the Home Buyer Confidence Index. The index is a measure of consumer perception and looks at 5 factors in relation to what consumers look at in terms of their circumstances. They look at whether it's a good time to buy, their repayments over the last 12 months, in terms of their history of repayments, their expectations over the next 12 months, their proportion of monthly income that goes to service debts, and the maximum LVR that borrowers are comfortable in borrowing. And as you can see from the graph, the index has increased twice over the last 12 months, most recently increasing 2.2% to 98.4, the highest since the GFC. What's fair to say about the Home Buyer Confidence Index is that there is a strong correlation between our index and interest rate movements in the marketplace. There's actually an inverse relationship. As interest rates go up, the confidence goes down and vice versa. We've seen the positive trend over the last 12 months, and that's in parallel with a 125 basis point reduction in interest rates since November last year. Now, we all know that sentiment's improved, and there are a number of reasons why. We've seen cost of living come down, primarily as a result of reduction in interest rates, which has flowed on to a reduction in mortgage repayments. Wage rises continue to be strong. Carbon tax fears have subsided, and the global environment has improved slightly, with the potential to the impacting Australian economy minimised, and fears over the housing market deterioration being reduced. But what would be interesting to hear today from the panel is, whilst sentiment seems to be on the rise and improving, how will that flow on to credit growth? Will we see an increase in credit growth coming through over the coming period as sentiment improves? Now, obviously, affordability plays a significant role in the appeal of entering into the home loan market, and the HIA Affordability Index is at its highest since 2009. Now, with a low interest rate environment and weakening property prices, although I must say in most recent times we've seen an slight uptick in house prices in capital cities across Australia, the proportion of those surveyed who said it is a good time to buy has reached a record high of 49%. And that's compared to 39% in our Streets Ahead report in March. Now, if affordability levels are maintained and unemployment levels remain steady, then conditions should be favourable towards home buyers. Now, another interesting factor is that our Streets Ahead showed that borrowers are expected to be less stressed in the year ahead, with 81% of borrowers confident that they will meet their future mortgage repayments. Again, the highest since the GFC. So a good time to buy and reductions in mortgage stress have had a big impact on our confidence and is behind the improved index result. Now, confidence is starting to come through in the first-time buyer segment. We, in 2009, saw the levels of first-time buyers as part of our overall origination probably hit the 30% mark. Now it's sitting around 19%. Now, the first-time buyer confidence came slightly down, about 0.5% in the recent Streets Ahead report. Nonetheless, it was still higher than the national average. But what was comforting was that first-time buyers, or potential first-time buyers, were less daunted in terms of their savings ability and their repayment capacity. 11% of potential first-time buyers said that they would find it difficult to save for their first home. And that's compared to 30% in the March Streets Ahead report. And those who said that they wouldn't be able to meet their repayments were actually 5% of potential first-home buyers versus 19% in the actual March report. So consumer sentiment and perspective is confident and optimistic. If we actually move over and contrast that, if we manage to move our Homegrown report, which is what we're all here about today, it's about contrasting and looking at consumer sentiment versus what you all say in the mortgage industry. And within the mortgage industry, there are absolutely different perspectives between brokers and various lender segments. When asking how you think affordability for first-time buyers will change over the next 12 months, 42% of brokers believe affordability will somewhat improve, while only 14% share the same view in the lender segment. Now, throughout our Homegrown reports, brokers have always been fairly and far more optimistic than lenders as a whole. It'd be interesting to hear from the panel today to discuss the disconnect between current market indicators, which do actually show a reasonably positive outlook, and the current views shared by lenders, who are somewhat pessimistic and conservative. The Homegrown report also revealed that many lenders and brokers feel that changes to government incentives in New South Wales and Queensland are unlikely to stimulate the first-home buyer market. Our Streets Ahead also showed that government incentives have a direct impact on consumer sentiment. An example of this is in New South Wales, where the first-home buyers felt that it were the lowest in terms of who felt that it was a good time to buy. And why is that? And that's probably because of the fact that the stamp duty waivers were removed in December last year. And so that had a flow-on impact on the first-time buyers' sentiment. I suppose the question to us today is, will interest rates on their own have an impact in terms of the first-time buyer entry back into the marketplace, and is it adequate? We asked about product innovation to both lenders and to brokers and how they felt that would impact the first-time buyer market, and they all felt it very necessary. Lenders agreed that innovation will be delivered through data analysis and customer insights, while some other lenders and brokers thought the opportunity is around targeting products targeted to various niche segments. The other thing that our Homegrown report touches on is credit demand. Credit demand across all lenders and also brokers felt that credit demand, and to a lesser degree brokers, felt that credit demand will reduce over the next 12 months. Unemployment remains a concern, unemployment security. Consumers are still looking at deleveraging, and they could continue to save. And also house price appreciation and sentiment is impacting the segments re-entering into the market, such as investors. In particular, the Queensland lenders, I did want to highlight, have struggled with pockets of low consumer sentiment, largely driven by higher than average unemployment rates and tightened credit standards. But when we asked lenders and brokers about what strategies they were going to look at to rely on growing their business in a weaker credit demand environment, lenders told us they were going to maximise their channel strategy, increase efficiencies, so take out cost in their overall process to allow them to remain competitive in the marketplace through competitive interest rates. They were going to continue to improve customer service and implement new approaches to segmentation. There's no doubt that different lender segments will employ different strategies to gain a competitive advantage. Now, what the non-majors said, for example, is that they were going to move away from a mass marketing strategy and look towards particular customer segments. Now, what the non-bank lenders said out there is that they were going to continue to focus on customer service. They felt that that was their only way to compete with the banks. And meanwhile, brokers feel that lenders should continue to focus on improving the overall turnaround times of their loan applications and enhance the broker experience. We looked at distribution channels, and it's pretty evident that the online channel is becoming extremely important, with the majority of lenders planning to make investments in the online channel over the next 12 months. 64% said they would actively grow their online channel. But interestingly, 43% also said that they wanted to grow their physical branch network. So that's still pretty much a key out there in terms of the branch network. Lenders and brokers feel that the optimal online experience included face-to-face communication, and also that was supported by what we saw on the streets ahead. Now, from a social media perspective, it's used to grow the communication and branding tool. Now, lenders continue to acknowledge that they're using social media to stay relevant with their customers, but brokers have a very different view. They're a bit more confident in terms of using social media to build their brand awareness and credibility for new and potential customers. So that's a bit of a summary of what we've seen. 2013 will certainly bring its challenges. It'd be interesting to see how we all combat those challenges. And what I'm going to do now is hand over to Ellie Comferford, the Genworth President and CEO, who's going to moderate the panel today. And I'm sure you'll hear their views on some of these themes that we touch on in Homegrown and a lot more than that. So thank you for coming today and appreciate your time.
So we're just sort of going to touch on some of the things that Bridget has raised. Vaughn, I think if I could start with you, I'd like to talk about your perspective on the market down here, now that you've come back to it, in terms of the reduction in credit demand that we raised and showed on the sheet. Do you believe that's the case? What do you think the implications are for lenders, for house prices, for upgraders, for the market in general?
All those questions.
All of them. All
okay.
of them.
Look, I think that globally what we're seeing is not only regulation, but also consumer attitude to debt change. So I think that lower credit growth is with us to stay for the foreseeable future. I can't see us going back to the 10, 20, 30% or whatever the growth was at some point in time. I think what's important is that you see consumers changing their attitude to the way they look at debt. So, for example, I think there's quite a lot of evidence across the industry that the reduction in the RBA rate and the consequent reductions in mortgage rates has not led to an increase in demand, but rather people actually paying off their loans earlier. So not only do I not leverage and keep on leveraging up? I reduce my demand for credit. Where we see the more concern about from some of the surveys that we've done is not so much about saving or borrowing, but concern about long-term retirement. So that sort of is where the switch is. For lenders, I think we have to get used to the fact that we can't just rely simply on growing volumes to generate more revenue, and that's why maximising, your distribution and your efficiency becomes very important. For us, we're very much, in terms of our distribution, a variable cost-based model. So I think that's something that we look to see stand us in good stead.
What about upgraders in terms of the move and seeing what's going to happen there?
Yeah, I mean, I think it's more to do with the fact that people are looking at the future. So, have I got a job? Is my income going to continually rise? And of course, now we're seeing a situation where maybe incomes won't continue to rise. Lower inflation. So I think people will be a bit more cautious.
Yeah. Damon, do you have a view on that?
I think our financial system is still, the envy of the world, and so we're very lucky that we've got moderate credit growth. I think the lending market's not a magic pudding. It can't sort of continue double-digit growth forever. So we're comfortable with the modest growth outlook that we've got. I think that's just the way the world has to work, and there's a lot of other industries in Australia that would be very envious of our situation. I think the growth for lenders is going to come through competition, through improving our businesses and eking out market share. So
with first home buyers though, and obviously that's near and dear to our heart, I mean our survey, as Bridget showed you, our survey shows that that's sort of on the wane and may be affected by government incentives. But also I think that we've seen a bit of a spate of increase in that. Bill, do you have a view on first home buyers and what they're facing, the market, the ramifications for them given the environment that we're in today?
Well, I think if we compare the first home buyers situation today with in 2009, the government doubled the grant for all homes, existing and new, to 15,000, and we saw a huge boom in first home buyer borrowing. But that did coincide with a number of other important factors: a huge cut in interest rates, a massive turnaround in how people felt about their job security. In 2009, people were terrified in the first half of 2009 about losing their jobs, and it was even more extreme than in the 89-90 recession. But about the middle of 2009, we printed a positive GDP report for March, which meant that we didn't have two consecutive negatives, which meant that Australia avoided a recession. And that headline really turned confidence around. People became a lot more confident about their jobs, and it really spurred the first home buyers off. This time, people are still very nervous about their jobs. I don't see a sort of a circuit breaker like that particular development in 2009. We've also got a background of extraordinarily, and I believe surprisingly, tight fiscal policy at the moment. And so I think the confidence thing for first home buyers is different. And of course the government incentives are quite different now, and some states have still only got the 7,000 for existing, like Western Australia. In New South Wales and Queensland, of course, they've got the 15,000 only for new. So I'd be surprised if we see any sort of real surge in first home buyers that we saw in 2009. That of course was a vintage period, but when the Reserve Bank saw that happening, they decided to spoil the party pretty quickly and started to raise rates in the October, having cut rates in the April. We don't think that'll be the case this time. We think rates will continue to come down, and then we'll have an extended period of low rates going well into 2014. And
do you think the incentives that do exist still, like New South Wales, will actually cause people to, first homers, to have a serious look at new construction?
I would think so. I think Meriton, for instance, are quite bullish on the initial inquiries into some of their properties, and if we think about how we go to try and release more livable space in Sydney, we know that the restrictions on the geographical restrictions are extreme, so Sydney has to go up, and that of course may well mean a lot more off the plan purchasing of apartments, and of course the first home buyer affordable apartments off the plan look to be a pretty good idea. So I think that will certainly provide some support. But the big confidence issue around job security, I think, is going to be missing in this particular episode.
So does everyone else feel the same on that? I mean, how are we going to get to first home buyers? If there's an opportunity there that still exists, how will we get to them? James?
It's interesting. I mean, for us, evolution and innovation has been a key for the last 21 years with Aussie. I mean, we started as a single home loan provider, a single non-bank lender, going to customers' home, and today we've managed to not only survive but thrive because of diversity of product, a diversity of distribution channels, a diversity of ways of getting to the customers. First home buyers today are one of those customers in which we get to probably better by having stores in local communities and stores in local areas where they feel confident and comfortable that there's a store manager, that there's a mortgage broker who's not a fly-by-nighter, that the next day and the next week and the next month that person's there so they can bring in their mums and dads or their family and meet, or if they have any issues or problems. So for us, we get to more people because of our diversity of distribution. Our store strategy, 7 or 8 years ago, if you told us that we'd have 150 stores, I'd say you're mad. Today, as part of our strategy, we have that because we need to layer a distribution strategy in order to get to all these levels of customers. It's just not good enough just to go out with a one stream or one distribution strategy, line of distribution, because the customers are so much more sophisticated today than ever before.
One of the key themes that emerged from the broker roundtable is that brokers believe that the current credit policy is excluding a large proportion of genuine potential home buyers. So it's sort of the same sort of question in terms of will risk appetite get more aggressive, but actually what it's talking about is the fact that deals can go through and they get the policy is set up, they may get scored, but actually they don't get approved. Do you think that lenders need to increase their vigilance around that? I mean, sitting with efficiency, do you think they need to really look at that and have an escalation point to make sure that the deals are getting done?
As a mortgage broker, we're in a privileged position that at any one time there are lenders that are pushing forward with the lending policy, becoming a lot more aggressive. At any one time there are lenders that are pulling back. We're in a fortunate position that we know at any one time who those lenders are and we can place the customers accordingly. So I think that we are in a fortunate position where we can actually serve the customer's needs, and where there are lenders that aren't being as aggressive, obviously they can be placed elsewhere that's appropriate to the customer's needs. So I don't buy the actual mortgage brokers saying that lender policies are too tough. Look, sure, at any one time they are, but that's why mortgage broking is about choice.
Do you think there's enough education in the market?
For mortgage brokers today, I mean, the education bar is happening more and more through the MFAA, Phil Naylor and the team. If you look at it every month, every year, the bar is being raised, and it's a matter of dragging the mortgage broking communities through that to make sure that they go through this education process. It's tough. People don't like change, but I think at the moment the pace of change is appropriate, and there's quality education that's out there.
Damon, do you want to weigh in on that in terms of what you're seeing?
Yeah, look, I think so using the broker example James raised, I think that's a great example of brokers have got a tough job. They're keeping track of multiple lenders' policies and processes and the way they work and their product structures. I think all lenders probably in that segment can improve in the way we communicate our strategy, our policies, and how our credit processes work to brokers to make it easier for them. I think some of us do a good job, but we could probably all improve. That'll help brokers explain things to customers and help channel them into the right solutions. Things we're doing in that regard are things like the tech workshops that we run a couple of times a year. So we run 2 rounds of tech workshops this year, where we had 50 different events around the country, had 2,000 brokers attend each sets of events, just to help them understand the technical nature of our products, because that's their tools of trade. So I think there's a lot we can do in terms of helping brokers to understand it. Consumers are a bit more difficult because they see things through a consumer lens and can't be expected to be experts in finance. So it's just a matter of making sure that you're clear in terms of your expectations with them and just sort of talking them through the process. In terms of expanding credit appetites for banks, I don't see a rush for major expansion of credit appetites amongst the banks. I mean, things have tightened up from a regulatory point of view, from a funding point of view, from a capital point of view as well. So I don't really see there's being any massive change as a whole across the industry, but different people will make different choices.
And we don't see it either, which is good for the media to hear and for the regulators to hear. But obviously then if we're going to cope with the slow credit growth environment and we talk about getting to the distribution and channel strategies, is it about innovation, and is it about, are there too many products out there? Is there more that we can do with products now? Do you see more products coming to market that perhaps are tailored to particular segments? Vaughn?
Well, before I go into that, I'd just like to pick up on the last point about
Absolutely.
the credit growth. We've heard a few people talk about different lenders with different risk appetites, and I completely agree with that. But I think one thing we must never forget is that at the end of the day, there's a customer. And we have a responsibility to that customer. So it's not about saying a credit policy is aggressive or not. We may look at that internally and say, my policy is probably a bit more aggressive than another lender's. But the primary purpose, I think, should be are we doing the right thing for the customer? And then linking that back to innovation, I worry about that a lot. Some people would argue that, innovation in mortgage lending got us into the global situation that we're in. So I think we have to be very careful. I think we always start with, are we doing the right thing for a customer? We are not selling, ties or shoelaces which, don't have made major impact. We want to make sure that we do the right thing for the customer, that if they buy a home, they can afford to repay it and not come up with products that are complicated, that allow volume growth and credit growth, but at the risk of damaging the economy or most importantly, the customer.
I think the innovation that is being raised here is innovation in the form of the product. What we need is innovation in the form of the funding of the product. The reason being that the banks are coming under much tighter restrictions under Basel III, and that's not going to change. The banks are reliant on offshore funding, and the rating agencies are uncomfortable with that. So the Reserve Bank, of course, is sitting there going, look at the mining boom, it's collapsing. It's been the thing that's been driving the Australian economy, so that they're now looking back at that part of the economy that's been ignored, which is the housing market in particular, which has been the weakest part of the economy, and thinking, how do we stimulate that? Well, they can stimulate it by cutting rates, but the real source of stimulus is, firstly, you need to improve confidence, and I think that will gradually come, but you need to improve the availability of credit. And I don't think the banks will be the ones that will be in a position to particularly support that. So issues around securitisation and those sorts of sources of funding, potential foreign banks coming back into the market, all those sorts of things, I think, will emerge if the confidence does return. And of course, what's going on in the global markets at the moment is that credit spreads are coming in. The Fed has been pushing massive liquidity into the world, as is the Bank of Japan, as is the ECB. The liquidity is crossing borders. They're looking for other ways to invest in other countries. That's why the Aussie dollar's going up. And if we can provide alternative forms of funding, then my expectation is that that will be the way that the housing market will move forward. So securitisation, those sorts of things, may indeed come back.
Are you predicting that?
I'm sorry?
Are you predicting that? We're going to ask you for predictions at the end, but do you see, securitisation is something we've seen that sort of pick up slightly this year, but do you see that as being something?
Well, I think if the Reserve Bank can spark an improvement in confidence so that people do want to save less and they do want to borrow more, the banks are not going to be in a position to accommodate that, and alternative forms of financing may well emerge.
Yep. When you talk about innovation, and technology has in the past sort of been synonymous, gone hand in hand with that, what do you all see as technology, the role it's going to play in terms of how you do satisfy service customers, get more business?
It's actually interesting. I think technology comes second. The first is actually the ability to create the product or the innovation, whatever you want to call it, to be able to use the technology to advantage. Simple technology per se doesn't solve the problem. And I think, one of the things that we often hear about is that technology allows us to do things quicker, faster, cheaper, analyse more data. I saw an article the other day where it said that technology allows us to do much more analysis of customer needs, etc., etc. And I find that interesting. For me, the first thing you've got to figure out is, what's the question I want to ask? And technology, of course, allows you to crunch data, but first, ask the right questions. The second question, I think, that technology can do, it can actually improve your efficiency and bring your cost down. But only if it makes sense for the customer. If I bring an international experience, one thing that we were doing in India was to actually reduce our approval time for our mortgages. And technology allowed us to do that, of course. But what the customer said was, so what? You can approve our loan in 3 days? Well, are you taking me seriously? Because they're used to a situation where it used to take 3 weeks. Right? So if you go too quickly, the customer actually doesn't believe it.
Yeah, look, it's technology is at the core of our business. It's like it's the bones which around our business is built. But it's also people. So it's always a combination between technology and people. We built a new website, a portal for brokers recently, which we launched last month, which enables them to see all their deals, where they're tracking in the pipeline, on their iPhone, on their tablet, on their PC, and just things like that enable the whole industry to become more and more efficient and deliver better service to the customer. But you're never going to replace the people either, so it's also critical to invest in the BDMs, the branch staff, whoever it is interfacing with the customer or through the channels, because they will always play an equal part in delivering service. So you've got to do both.
James, do you have a view on that?
It's interesting. I mean, we're in an industry today with mortgage broking that our business is obviously attracting and retaining top-level salespeople and mortgage brokers, and these mortgage brokers will stay or leave in many cases because of your technology, because of your ease of technology for the interaction with the customer and the ability to help run their business. So that really didn't exist 10 years ago and 8 years ago and 5 years ago as much as today. So technology in mortgage broking is huge. It's becoming more front and centre than ever before, and consumers are becoming so much more savvy. Where's your mobile site? Where's your tablet site? It's so for us and for our business. We're someone who's investing $1 zillion, reinvesting in technology. But some of our key competitors who don't have that same sort of backing are going to fall by the wayside, because it's an industry where if you're not up to scratch as far as technology is concerned, as far as the broker is concerned, as far as the consumer is concerned, you will be significantly left behind. So it's certainly front and centre from a customer experience point of view in our industry.
So that's morphing into that online, and we are all seeing that there are changes in that, perhaps not as fast as some would have imagined. But a strong theme that came out of the report was that brokers are seeing higher conversion rates on that online. And I know it's semantics and you've got to do definitions, but why do you think that would be the case?
The vast majority of customers today come in one way or the other, come via the web, come via online. So they use it as a brochure, a shopping tool, an information tool. So the vast majority of them today come via there some way. Yeah.
Are we seeing any true online applications occurring, and when, if not, when?
We are. So Ubank, for example, online application. There's others in the marketplace as well. So yeah, end-to-end. Customers will apply online, but not everyone. Most people use it as a shopping tool to check out rates, to research what they're interested in, and at some point switch to a face-to-face channel or a telephone channel. That's the predominant use at the moment. But there are customers, and a growing number of them, who will go all the way online.
And how fast, when you say growing, do you think that's going to change? Certainly both Homegrown and Streets Ahead, as Bridget said, are saying that they still want that face-to-face. I use teenagers as the litmus, and they want to do all the research online, but they want to look in someone's eyes. And
yeah, look, it's going to take a while. Like, you look at credit cards, which are a pretty simple product. Probably only 30% of those are sold online at the moment, and so that's been available online for a long time. Mm-hmm. So mortgages, it's going to be a slow burn, but you have to be there from a presence point of view to give people information and entice them, but you have to have the other channels behind it.
Ellie, I think, we do see online, but I think there are two factors in there. Firstly, that in the event that they do need some support, they need access to that. Now, for us, it's basically either the broker channel that we have or the call centre. And I think that you can support it with a call centre, but the call centre's got to work. I don't know, many of you ring call centres. People have shifted call centres offshore for cost and efficiency reasons, but no one's going to spend 2 hours waiting in a queue. So if you can actually support your online with an effective call centre channel. And the third factor, I think, is that if people are comfortable with the brand and are used to you. So somebody who doesn't know you is probably less likely to go online. Mm-hmm. But if they've had a good experience with you, maybe other products, then I think it's possible. Mm-hmm. So I think it's all about, the nice thing about physical presence is that I can actually pigeonhole somebody. If you have a problem, I don't know if any of you say, but if you do an offshore call centre, you can't get to speak to the same person twice. And you just don't know what happens with your query. But if you can support it effectively, then I think it will work.
My next one is in regards to, and I guess it feeds from data analytics, but also the fact that comprehensive reporting will be coming into the market at some stage. Vaughn, from your perspective and having that international look-see and seeing this probably working in other operations, how do you think that's going to impact the market here?
You mean data reporting?
Comprehensive reporting.
As Fiona said, technology allows us to do that, do it very quickly. So, fine. I mean, I can remember when I first started off having to input data into a spreadsheet on Lotus 123. Those days are long gone. So I think we have the technology. I don't see that as...
So no cause for pause in the market as we have more access to information?
It's what you do with it. Mm. And that's the point I made earlier on. What worries me more is that we produce ever more data, and yes, there'll be more transparency and all the rest of it. But the winners will be the people that can actually create the insights. I don't know about you, but I'm sick to death of 66-page PowerPoint presentations to be done in 45 minutes, which is just data everywhere. Those key insights, I think, will make the difference. So, no.
Is this something NAB's looking at in terms of the impact?
Well, we're all looking at comprehensive credit and getting ready for it. There's a lot of data analytics underway across the industry to understand how we actually adjust for it. I think it'll be a positive thing for customers because banks will be able to better distinguish who's likely to default and prevent that situation, which is good for everybody. Be better for lenders because it will increase their efficiency, and I think particularly broking channels where a large percentage of their customers are new to bank customers will get more benefit out of it than banks at the moment because they have a lot of information on their existing customers already, and so they already have their mini positive bureaus already, and so the incremental benefit is really on the new customer side, not the existing customer side. So channels that introduce a higher proportion of new to bank customers will be more beneficial.
Bill, do you see anything sort of factoring in terms of the fact that more information will be available on borrowers than ever before?
Oh yeah, look, I think that's been one of the reasons why banks have been able to contain their credit issues so well with the information that they're getting now. We've been through some pretty big cycles, and yet the default ratios on the bank's balance sheets have been minimal. So I think part of that is the ability to analyse risks more efficiently and to act accordingly. So it's certainly been a big, very important aspect for the banking system.
Yeah, and I guess my view is when you look at the broker channel, this time last year when we did this survey and we surveyed people about what percentage the broker market would continue to make up on origination, the consensus was it would get up to around 55%. We're sitting here today, depending on whose statistics, at around, someone said 47 yesterday, somebody else said 43, but it's clear that it is a channel that's continuing. One of the themes that came out of this is that actually some lenders have started to add a broker channel to their strategy, or some have seen a lot more growth coming out of that channel in the last year. So I'm wondering, what do you think is driving that? Is that I was really tickled pink, actually. The thing that came out of the report says that brokers work much harder than lenders. So do you think that's true? Yeah. Come on, James.
I think that's true, Ellie.
It literally says that they work harder. How do you think they work harder? And why do they have to?
You know, the mortgage broking industry, it's one where the consumers love it because it's choice. You know, at the end of the day, the more the consumers understand what the proposition is, it makes it a very easy prospect to sit down with a mortgage broker and go through 2,000 loans, XYZ lenders, and come up with the appropriate loan for them. So obviously the actual offering is very, very good. The vast majority of mortgage brokers in this country are commission-only people. You know, they eat what they kill. So in terms of that's a nice way of saying it. In terms of, so you know, these guys and girls, whether it's Sunday night at 8 p.m. at night and they've got to go to a customer's home or open their store or what have you, they do it because they have to do it, because that's their living. You know, and they're so used to customer service and customer experience. A mortgage is a mortgage is a mortgage. You know, you can get a mortgage anywhere. It's what differentiates yourself is the customer experience that you can provide. So mortgage brokers are so used to, especially the top-line mortgage brokers, offering just a wonderful customer experience proposition because they have to. You know, they have to because in their toolkit, which is the same as the next person, and their product kit, which is the same as the next person, one of the only key differentiators is the customer experience.
So working harder and harder and harder.
Working harder, working smarter, always being innovative, and really focusing on customer experience. I mean, the words customer experience in the last 5 and 6 and 7 years, getting to know your customer in the mortgage broking world didn't exist as much because there was so much business out there. The last 3 or 4 years has really cleared the sinuses of a lot of players.
So when you look at that customer experience, and one of the things we're hearing back is that customers are extremely disappointed when they go to get a loan and they find that their property is not valued at what they thought it would be valued. If you ask any one of my people, that, I mean, the biggest challenge they have is probably not credit criteria. The biggest challenge they have in today's market is valuations. Is particular for refis, particular for new home constructions, is valuations, and valuations obviously coming up to, you know, expectations or up to purchase price or what have you. So credit criteria is second to the valuation coming in at an amount that is, you know, seen to be appropriate from the customer and, you know, or the purchase price or what have you. That's the challenge. Yeah. I think it's an area that we've seen a lot of change in and we'll continue to see more, and I think maybe the pendulum will swing back to maybe the happy medium from where it is now.
I always find this valuations questions interesting. Everybody wants to see the value of their house go up if I've got a mortgage, but all it means is that if I'm going to trade up, I've got to pay more for the next one. So I'm not sure how it works. But I think the important thing for me is, you know, a lot of people say it's good that values go up. But let's always remember that we don't lend against values. We lend against people's income. The value is their security. And we shouldn't rely too much on valuations. Otherwise, we end up in an endless spiral. That's my only caution on valuations.
Second way out. I'm going to ask you all a question that wasn't on your list, that I get asked very often. I'm going to ask it slightly different. And Bill, I'm going to start with you. Why isn't there a housing bubble in Australia?
I think you need 3 conditions for that. The first condition that you need is oversupply. And as I said before, one of the real issues around the Australian economy is that we haven't been building enough houses. And that's been a factor for many years, for 10 years in New South Wales. Victoria has done rather well, but New South Wales and Queensland have dragged well behind. So we haven't overproduced houses. I think the second condition is that you need a credit crunch. And that's clearly what happened in Spain and what happened in the US, and oversupply, and what happened in the UK. And we're certainly not having a credit crunch here. The banks are keen to lend. I think the only issue is that the banks will feel that if we were to look for a real rebound in credit growth back to 10% or something, the banks wouldn't be in a position to support that. But they're certainly not going to be restricting credit. And the third one is a stretched affordability. And I guess by some measures Australia does have stretched affordability, but certainly affordability is improving as prices have come down and incomes have continued to rise and interest rates have come down. So it just looks very, very unlikely that we've got a housing situation that could lead to a substantial fall in values. Now, having said that, I had breakfast last week with one of the senior fund managers in New York, who looks at Australia and says it's only a matter of time before your housing market collapses. I've seen it before, I've heard all these arguments, but bear in mind it's going to happen. So there's still lots of people out there that believe that we are on the verge of some sort of crunch, but I really don't see it because of those factors that I mentioned.
Anyone else want to wade into this debate?
a few years ago, I was sitting at a table with a very prominent international economist and some senior figures in the finance industry. And the talk back then was about the probability of a housing crash. And all this time later, it's not happened. For me, I think there are two parts to the argument. On the demand side, I think that we still see an increase in the demand for housing. So, Australia has still an increasing population. Secondly, people are living longer. There's more single-person households. And I still think, I haven't seen the stats lately, but I still think there's migration into the major cities. And on the demand side, at least the numbers that I see, and Bill would know better than I do, there's still a shortage of houses. So at this point in time, I still think there is a demand-supply which keeps prices buoyant. Whether that leads to increasing house prices, I think, is a different discussion. That goes back to the availability of credit and the ability of banks to provide that credit, either because of customers' incomes or the funding situation. So I also get the same question all over the world where I go, where people are looking and saying Australia has all the characteristics of a bubble. But our analysis, and we had our global chairman out here, so of course he asked that question, suggests that we don't think that's going to be the case. So I agree with Bill.
Yeah, like I said, similar views. I mean, nobody really knows, of course, but the fundamentals of the economy remain strong, employment remains strong, we don't have an oversupply issue, and the banks remain well capitalised and conservative relative to some of the organisations overseas that have got into trouble. So we still think that things are relatively healthy. We don't see property prices, rising dramatically, but we're hopefully going to see a stabilisation, maybe modest increase.
But Ellie, let me add that I'm so delighted that I passionately believe that, because working for an organisation that has 60 to 70% of its assets in that market, I think it'd be a very career-limiting move to be predicting 40% falls in Australian house prices.
Yeah.
Will you let us know? So the housing market's not going to crash, or it's not going to fall by, what was the numbers, 35% in the stress test recently completed. Consumers' sentiment may be on the increase. We've got enough innovation. We're all looking at our technology. Online is a happening thing and moving more in that, but you still need to eyeball the person. I'm going to ask each of you, what is the outlook in 2013? Are brokers going to continue to work harder than lenders? Are we going to see other ways and forms of sort of trying to promote credit growth? Or are we just going to have steady state, solid performance? James, you want to go?
Well, I'm the humble mortgage broker up here versus the big bad banks. So we have to try harder. We have to work harder. 2013, yes, that's you, Bill. 2013 for us is another year of opportunity. I mean, we're very lucky that we're in Australia in the residential home loan sector. So if you're going to be in a business sector that's as close to a commoditised sector as you can get in this marketplace, we're very fortunate to be in this sector. So residential mortgages in Australia is something that is still a business and an industry that's still powering away, and for us it's trying to capitalise on that and gain market share. The pie is obviously not growing as much as it used to, and so therefore it's about doing things better, faster, sharper than the next person. So for us for 2013, we've had some stellar growth. Last month we were up 27% year on year in terms of our sales results, and our business results are up. So for us, it's a good thing. The opportunity for acquisition is also on our radar, and for us, acquisition from a distribution point of view is very, very strong. And we only see it as 2013 as a year of growth and as a year of more fun. So we don't see anything that's untoward. If there is a bubble that bursts, we're all stuffed. But Bill assures us that's not going to happen.
We're in it together.
Vaughn.
Well, I'm surrounded by the big bad banks and the big giant of the broking industry, and here we are, the humble second-tier lender.
International.
Look, for us, I think the world has changed. It's no longer but just simply about continuously 20, 30% growth. And I think that we have to adjust to that. So for us, it's saying what's really important is actually continue to improve more than customer satisfaction, we look at the Net Promoter Score. So, do your customers really passionately believe in your organisation, engage with you? So it's about improving not only the number of customers that we have, but increasing the activity of the customers and what they do with us. So growth takes a different shape or form. Of course, we would like to continue to grow the business, but only if it makes sense for the customer and within the risk parameters that we think we can operate.
Good. Damon?
We see the broking channel as a key contributor to growth in the next couple of years. We have customer satisfaction scores at record levels at NAB in the 80s. And when we survey our broker-introduced customers, they are as satisfied or more satisfied than our proprietary channel customers. And when we ask them about how satisfied they are with brokers, they're scoring brokers 8.5 out of 10, which I think speaks volumes for consumer demand and ongoing sustainable growth for the broking market. So we're going to continue to incrementally improve what we do for brokers and for brokers' customers, and we're expecting a lot of growth through that.
Okay, and Bill, when you're giving us your outlook, could you let us know when the next rate reduction will be happening, please?
Look, I think in terms of the big picture story, the Reserve Bank has, back in 2000, a lot of the metrics that we saw in the report today indicated that sentiment towards housing is back at those sort of 2008-9 levels. In our own survey, we found it's now a good time to buy a house. That's now at the level that we had in December 2008. And in 2009, house prices went up by 15%. New lending for housing got up to 30%. Housing credit growth got up to about 7%. But of course, the Reserve Bank still was of the mindset that we have to make room for the mining boom. And as soon as we saw this other part of the economy picking up, they ramped up interest rates again in October 2008 and in 2009 and slowed things down pretty quickly. This time around, they won't do that, because this time around the psychology is the absolute opposite. They can see the end of the mining boom. They can see that the sort of metrics that we're getting out of the mining industry are quite scary. Some industry analysts are saying that 80% of coal mines are now underwater in terms of the price of what they're producing is less than their costs. And of course we can see the end to the boom in gas investment. So they're now looking at the economy and going, well, it's not a matter of making room for the mining boom, it's a matter of finding out how we can complement the slowdown in the mining boom with some of the more traditional interest rate sensitive parts of the economy. So that means that interest rates will have to come down further. If I look at the stance of monetary policy at the moment, in 2009, interest rates bottomed out at 150 basis points below neutral. They're currently about 75 below neutral. So there's plenty of scope for interest rates to come down further. And there won't be this paranoia about, we've got to make room for the mining boom. There'll be this feeling that we should encourage these other parts of the economy. But the issue will be around the availability of funding to accommodate that. I would be very surprised if new lending got up to 30% growth in the way it did in 2009. I would expect it'll peak out around 10 to 15%. Credit growth, housing credit growth, we think will only be around about 5.5%. And that's the point that I made before. If we were to see demand and confidence in those sectors of the economy not being accommodated by the availability through the traditional channels, then we may well see other entries into the market to accommodate that. And if the confidence is strong enough, then it's possible that might happen. But I don't think it's going to happen via the traditional channels that we saw in 2009, where new lending by the banks reached a 30% pace. Credit growth never got there because people continued to pay down their debts early, because you've still got a lot of risk aversion there. But so that's what we're facing this year. And I think that, I'm relatively optimistic that certainly that the Reserve Bank will be partially successful in filling that hole in the growth, and it is going to be quite a big hole in 2014 with a stronger housing, consumer, and sectors of the business community that service that part of the world.
And rates are going down.
And rates are coming down further, yes.
December?
I would expect that we'll see one on in December, but there's a lot of focus going to be on the wage price index tomorrow because the Reserve Bank doesn't get another read on inflation until the 23rd of January, and we know that they're very focused on inflation. But I think if they see the wage price index tomorrow being benign, which would be a print of 0.8 or less, then they'll feel in a way to be able to cut. The other big issue will be around the investment outlook that we receive the following week, where we'll get a really good guide as to exactly how quickly mining is slowing down, because we saw a report yesterday indicating that projects under construction at the moment have been revised up only because their costs have gone up, which means it's becoming less and less likely that more will come through. And projects under consideration have been slashed because people are just no longer interested in accommodating that, given where the commodity prices are. So the emphasis is moving back to your industry, ladies and gentlemen. So it's up to you to try and find as many different sources of funding to allow this thing to happen.
That's a great conclusion. Anyway, I wanted to thank the panellists. Really, that was not controversial. There were some very interesting things that we covered, and thank you for your contribution. It's been excellent. The report, as I said, is available on www.genworth.com.au/homegrown. If, when you get the chance to read that report, you'd like to spend any time with the team, they're on standby today, whenever, to really sit down with you and do some digging and to see if we can help with any of that strategising around channel and distribution. Thanks, everybody, and thank you.
That concludes our wonderful panel session with a lot of fabulous information from our 4 industry leaders. Again, a huge thank you to Genworth for sharing their homegrown breakfast session. As Ellie suggested, for those interested in downloading Homegrown, www.genworth.com.au/homegrown, and you also have the opportunity to download Streets Ahead, www.genworth.com.au/Streets Ahead. I thank you for your time. If you have further questions, please direct them to MFAA at professionaldevelopment@mfaa.com.au, or you can contact us directly on our 1300 number, 1300 554 817. Have a fabulous day.